thank you for being with us.
Well, good morning.
For having us here.
Good morning, David. Welcome to Boston on Veterans Day.
Yes, that's right. Let's get right to it, Larry, in terms of Friday and the action in the stock price, what may have been a reason why. We're very welcome and happy that you're willing to talk to us. But a well-regarded analyst, Stephen Tusa, who's followed the company for some time and been typically right in terms of the direction of the stock, came out on Friday with a new report in which he basically says, a lot of things, but to cut to sort of the key ones. $100 billion in net liabilities he sees at GE, roughly speaking, currently for a company that's generating negative free cash flow, even after the dividend cut, with deteriorating fundamentals. A, is he getting any of that wrong? And B, if he isn't, what do you tell investors to keep them in the stock?
Right. Well, David, I think if we look at the last 2 weeks, right, clearly the stock has been under pressure. No doubt about that. I think when we announced on our earnings call that we were taking the dividend down to 4 cents a year, we didn't do anything positive for our retail shareholder base, and they have been exiting the stock, I think, as a result. And at the same time, we took another unpopular decision, but one that was straightforward, and that is to take guidance off the table, given the fact that we didn't really have, I think, the confidence and conviction that we would want, particularly around our power business, as we look toward the end of the year. That didn't do much for our institutional holders. But I think if you step back from all of that, and given the way the stock's traded, I think we'd make those same decisions today, because those were the right decisions to make sure that the company is facing forward and dealing with the fact that we do have a lot of leverage. I think we all agree in that regard. But we have a number of options to bring that leverage down over time, and the company is very committed to doing that.
Yeah, that was a focus to a certain extent of the conference call that took place 11 days ago, or wherever we are, roughly. And it also was the focus of Mr. Tusa, though. It wasn't necessarily about liquidity as much as it's what he thinks is excessive leverage at GE. And you seem to agree, although the numbers may differ a bit. But what can you do, particularly when it's not just the amount of debt, but it's also the fact that EBITDA and free cash flow is not going up?
Right. Well, a couple of things there, David. One, I think that's an important distinction you just made relative to liquidity versus leverage. 2 weeks ago, folks were, I think, understandably asking the liquidity question. I think we've put that to rest, given the fact we've got $20 billion of cash. We have a robust Tier 2 CP program and $40 billion of bank lines. We've only tapped 2, but I think that gives us a foundation.
You've only tapped 2 of the $40 billion available to you.
So that gives us a foundation to really talk to the leverage. And again, whether it's an equity analyst, whether it's the rating agencies, witness the downgrades, or what we've said ourselves, we need to bring the leverage down. And I think we've got plenty of opportunities through asset sales to do that. In the last 6 weeks, this is my mark 6 weeks on the job, I've heard from lots of people across our markets, people who have interest in GE assets. And I think that's confirmation that we have quality franchises and, frankly, that we have options.
Are you going to quicken the pace of asset sales at this point? Is there a sense of urgency?
Very much a sense of urgency, David. But as John Wooden, the famous basketball coach, said, be quick but don't hurry. And I think that's the mindset that we have. If we look at healthcare, for example, a tremendous franchise. We talked in June about an IPO there where we'd take 19.9% of the proceeds as cash. We have flexibility. We have options there. We could preserve our tax-free spin status while selling up to 49.9%. So there's a lot of cash there, given some of the estimates of value that are out there. We're tracking very well with the closure of our merger with Wabtec, with our transportation business. We'll end up with just under 10% of that business in equity, another option there. And Baker Hughes. A lot of people have talked about Baker Hughes, a $28 billion market cap company as of Friday's close. We own 62.5% of that company. So lots of options just in those three to generate real cash to bring that leverage down.
Right. On Baker Hughes, why not just move? Why not accelerate that now? People have been focused on it. I know the price of oil is all over the place. It may not be the best time from a valuation perspective. But when you referenced it on the conference call, you still used the word several years, I think, is what I saw here in terms of exiting that position. Why not get moving on that sooner?
Well, I think we're going to try to look at everything and all of our options, again, with a sense of urgency. What we're not going to do is talk with great specificity about certain opportunities, certain paths, because we'd rather talk about what we've accomplished after the fact than negotiate in public.
What should we think about in terms of leverage then? What should investors be focused on? You mentioned, obviously, it's a focus for you. You mentioned a couple of markets that are reacting to it. Your CDS spreads have widened as well. Does that concern you?
Well, I think there are a number of ways to look at our leverage levels, but let me be absolutely clear. We have no higher priority right now than bringing those leverage levels down. It's important to strengthen the balance sheet. It's important for our investors, the rating agencies, everybody with an interest in the future of this company, not to mention the fact that it's tough for our businesses to play offense as often as they should, organically and inorganically, with the balance sheet in the shape that it's in.
Another of the contentions made by Mr. Tusa and some other analysts, to be fair, is that fundamentals continue to deteriorate, not in aviation, not in healthcare, but in power. I mean, in the numbers that Tusa had in terms of your potential earnings, I know you're not giving guidance, 35 cents a share in 2019 and 41 cents a share in 2020. When you see or hear those numbers, does it make you shiver?
No, it's a cold morning here in Boston, but I haven't shivered yet because we are working very hard with the power team to get a better grounding in our reality, and we aim to run that business differently. I don't have the conviction to offer up numbers for the fourth quarter, let alone 19, that we will in time, right? And that's very much what this week's about. It's what the last 6 weeks have been about in terms of getting closer to the opportunities and the challenges in that business. The unfortunate thing there, David, is we probably held on, with the benefit of hindsight, held on too long to a too robust revenue outlook for the year. We're going to fall short of that. That hides a lot of the progress the team has made in terms of cost reduction. We've taken out over $700 million of cost in that business this year. We've reduced our facility footprint by 20%. Good things to do in a manufacturing business, but it's not enough.
Has power bottomed?
Has power bottomed? We're getting close.
We're getting close. Will you know when you're there?
We will know when we're there, right? Because like any business facing both cyclical and secular pressures, it's a little bumpy on the way down, somewhat unpredictable, but I think we have good line of sight. We can have good line of sight in this business. We've got $94 billion of backlog, for example. That should give us, I think, the potential to run this business not only better, but with better visibility.
And I've mentioned, of course, you were the director as of April. You've been in the CEO job, as you point out, about 6 weeks.
6 weeks.
Have you, though, in your mind, diagnosed what the issues were at Power so that you can effectively deal with them and get to the bottom quickly and then potentially start to pave the way forward?
David, I've done this long enough to know that there are always things that you may not know. But I feel pretty good today that we've got line of sight on the issues that we can manage to improve the performance of the business and address the risks inherent in it. One of the things we're going to do that we announced on the earnings call is really stop managing the business at a consolidated Power level and really run the 7 discrete P&Ls on their own bottoms. We have a big Power organization, consumes about $300 million of cost a year. And when you're managing at a consolidating level, it really robs you of the visibility relative to revenue, cost, and cash opportunities, business by business by business. So as we do that, we're going to be able to address the specific issues in each of the business, in our gas franchise, and in the other businesses within the Power segment.
Have you been bringing in new people? Do you need to continue to change out personnel?
The team is going to continue to evolve. I've said on the earnings call, and I would say again today, I've been really impressed with the people on the GE team. They're smart, they're talented, they're passionate, and I think they've got an above average level of grit and resilience given what they've been through. But that said, we're bringing in new people. We have a new GC, Mike Holston from Merck, who joined us earlier this year. Tom Timko, our new controller from General Motors, is a tremendous addition to the team. We've brought in a number of outside advisors who are helping, and there'll be other changes as well as we evolve the organization. Some folks, perhaps, who are here today who will be in different roles, others who will be promoted as we complement their strengths and their skills with folks from the outside.
Did the Alstom deal break Power, or was Power already on a road that might have ended not well?
David, it's a hard one to answer, but I think if you step back and look at the hand Russell Stokes and his team were dealt a little over a year ago, I think there are three things in play. First, the secular and the cyclical pressures as we go through the energy transition in that space, all things Alstom. And then again, the way we were structured and the way we have been running this business. Those things relative to the market are our reality. We need to embrace them in order to change them. But in terms of our own operations, we have a lot within our control. As a former GE chairman once said, we can control our destiny in that regard, and that's what we aim to do.
You know, a little more than a year ago, I sat with your predecessor, Mr. Flannery, not right around the corner here. We didn't do it in this exact spot. He talked about sort of having a handle on power.
Right.
What gives you the confidence, given your experience, that you have a handle on it?
Right. Well, I've run businesses for over 25 years, from the shop floor, from the lab, from the customer sites. So I take a bottoms-up approach. I could be wrong, but I have a lot of confidence that we can do what we need to do to stabilize power and then drive a better performance in terms of the top line, the bottom line, and most importantly, David, in terms of the cash generation of that business. We have $7 billion of cost in that business today. Our inventory turns are only 4x. Plenty of opportunity to run that business better.
Now, you do have two other businesses that we tend not to speak about as much because they're doing fine. Aviation, right, of course, which everybody calls the jewel to a certain extent, and healthcare.
Right.
You just had alluded to the plan for healthcare in terms of potentially taking 19.9% of it public at some point. You said the plan is intact, the one that the board agreed with and came to back in June of this year.
Right.
Is there a chance the plan will change?
Well, what I would say, David, is that I think the strategic intent that we announced in June stands today. And I believe deeply in what we said then and what we reiterated 2 weeks ago. The plan basically has two strategic pillars. The first, deleveraging, and we've talked about how important that is. The second is we want to run the company differently. We want to be a more decentralized business, focused more on the discrete businesses like aviation and healthcare and less on corporate. The details as to how we get there, 19.9% of healthcare or something more, maybe something in some of the other businesses, we have lots of options. So those detailed tactical implementation decisions are under review, and we're going to be smart about how we phase and sequence those moves. But they all serve that strategic intent that, again, is a constant.
What about aviation? Does it just stay? Can it not be potentially removed? Is there not an opportunity in some way, perhaps, to break out or monetize a bit of it to show the value and raise some equity?
Well, there are lots of opportunities here, and I wouldn't dismiss anything once and for all. I think that would be foolish. But there's no question, as you said a moment ago, aviation is our crown jewel. David Joyce, our vice chair, and his team have done a phenomenal job with that business, have, I think, tremendous runway going forward. So we wouldn't say no for all time to various options, but options along the lines of what you just described, not high on our list today.
Your customers in aviation sign up for long-term agreements. They need to know you're going to be there to service all those jet engines and everything. Are you hampered at all in the marketplace by a deteriorating credit rating and by perhaps the longer-term concerns of some of those customers?
David, the customers I've talked to could not be more supportive. They certainly understand that we're under a lot of scrutiny, receive a good bit of criticism. But when I talk to them, what they ask me is, what can I do to help? At the operating level, you're performing well for us. We need GE. GE is important to our business. GE is important to the country. If there's anything that we can do, let us know. In terms of our degrees of freedom from an operating perspective, the businesses are up and operating without any challenge in that regard. And that's been a pleasant finding.
You know, for many years in following and actually being an employee of this company as well, the conglomerate model was lauded. It was seen as a positive. In other words, the performance of one business actually in some way helped the others.
Right.
It would seem to me now to be going the other way. You have two strong businesses. You have one weak business. And I wonder, can you retain and attract the talent you need and maintain morale when in some ways you seem to not be able to say, well, if you do great in aviation, you're going to do great at GE, because you're attached to this power business and GE capital and long-term liabilities and things we don't know about that conceivably could impact your future.
Right. David, there's no question with the stock where it is and the criticism we've received that employees here feel that, right? More so, I think, in the U.S. than outside of the U.S. But again, I think what I have seen is a level of commitment, a level of grit and resilience to fight, to continue to serve customers, to be a part of the mission that we have in each of our businesses, and to serve the greater GE. Nobody's happy with where we are today, and they want their company to be on better footing, and that's what we're working to do every single day.
And can you attract the people you need to and keep the people you want to keep as well in that environment?
Well, we have to prove that out. I've been encouraged by the response I've gotten from folks I have reached out to, the folks that have basically contacted me directly. Not everybody is going to be attracted to a challenge like this, particularly given where we are today. But the people we want, frankly, David, are, because they don't scare easily. They're up for the fight, and they're ready to fight and win.
You know, that brings me to you. You're a 37-year-old CEO, 14 years later, a great track record at Danaher, compounding of revenues, of the stock price. Many people would look and say, what are you doing this for? Why would you take this on, given you had a strong reputation? You made plenty of money, it would seem, not to be presumptuous.
Right.
What would motivate somebody to do this?
Well, David, I think it was not an easy decision to join the board, frankly, let alone when the board asked me to consider becoming chair and CEO to take this on. But I think the decision points in both instances were driven by the same logic. I think first and foremost, I know, having looked at this company for a long time, GE is important. What we do in terms of aviation, healthcare, energy, it's important. And frankly, this company matters, particularly to the United States. This is a challenge of a lifetime, given where we find the company today. And that's certainly worth doing as well. But more than anything, I think I go back to the annual meeting in April, my first board meeting, where I began to see GE shareholders, GE employees, pensioners, people who had perhaps been working for the company second, third generation, all very unhappy with where we are, but again, committed to the company, keen to see the company be in a better place. And I thought if I could be helpful, if I could serve those people, that would be a good thing to do at 55.
But you're going to be at it potentially for a long time. There's no magic bullet here. It's not like you're going to wake up tomorrow and suddenly have it all figured out and the stock's going to be a double. It's going to take, if you're even right, a long period of time for you to turn this giant around, isn't it?
Exactly. And that's the beauty of having 14 years in the chair in a prior role and being 55. I've got, I think, the energy and the runway to do what it takes here. It's been 6 weeks. It's been a great 6 weeks, frankly. It's been energizing. But we didn't get to where we are in 6 weeks, so it's going to take a while. And I'm signed up to do that.
Finally, Larry, you know, when it comes to the stock itself, and I hear from a lot of people, as you might expect, in the halls of 30 Rock as well, fellow colleagues who own GE and have for many years and are obviously disappointed. But when you talk to other potential investors, they still sort of feel uncomfortable because of the unknown. And that comes back to GE Capital. Right. Long-term liabilities, long-term care liabilities, for example. Can you give people comfort? Do you feel like, having been a director since April and CEO for the last 6 weeks, that you know where all the liabilities are and that the numbers are the numbers with no surprises?
Right. David, I think that if you look at capital, our intent there is clear. We know we have too much debt overall. We have too big a GE Capital business, which is why we've been materially shrinking that business, down $25 billion this year. That work will continue. We've got a number of great assets there, and it's important that people remember we've got assets that match the liabilities. It's a matched book setup. Specific to insurance, we took a big charge last year as we trued up our...
Which scared the heck out of people, to be fair.
I think there was nobody who heard that news and didn't have their breath stopped for a moment, right? Again, a big number. But in terms of what we're doing there, no issue at Capital gets more attention. In our management meetings, with our discussions with outside actuaries, frankly, at the board meeting. I can't think of a board meeting this year where we haven't spent a good amount of time on managing that insurance obligation. And as we go forward, while it's not a liquidity pressure in the short term, we know we need to tend to that, and over time, we're fully committed to exploring every option we can to manage that liability and de-risk it for the GE shareholder.
And finally, Larry, this idea of a large shareholder or somebody coming in to help you in terms of an equity check and giving confidence, is that a possibility or is that not something that's on the table?
Well, the stock's on sale today, and I'm sure people are buying it here at the market open. But we have no plans for an equity raise, David. I think that as conditions change in the future, we might come back and reconsider that. But we're very keen to deleverage. We think we've got a path by way of the asset sales to do that, and that's the plan we're going to work.
Larry, very much appreciate your having us in today. Thank you.
Thank you, David.
Larry Culp is the chairman and CEO of GE.